Hello everyone, my name is Anjani Kumar Khetan. I am based out of Bangalore in India. And in this particular video, we will continue our deliberation from the previous video. Now we will pick up what happens if the decommissioning liability which you initially estimated, if there is a change in that decommissioning liability and the estimate changes over the period of time. Then how do we deal with it? That is what we are going to look at in this video. So we will continue to look at the similar kind of example what we have looked at in the previous video. Just to set the context quickly, we have already looked at this particular slide in the previous video. So I'm not going to go over again. For your benefit, what I can do, in the description of this video, I will also give a link of the prior video. In case you have not gone through that video, please go through it because that will set continuity of what we are going to discuss in this particular video, right? So you would have seen, if you have gone through the previous video where we are in, simply we have said that when you have a decommissioning liability, the original cost of the property, plant and equipment is required to include present value of the estimated liability at the end of the period, let's say a future period of 10th year in the example which we gave, wherein you have the liability, right? And the measurement will be at the present value because paragraph 45 of IAS 37 or Ind AS 37 gives you the measurement principles, wherein it says that if the time value of the money is material, then you do the discounting and give effect to bring in the liability at the present value. Now, this we have seen. You can look at more in case you want to deep dive into this concept in my previous video. Now, having understood this, now the moot question is, if there is a change in the liability. So in the previous example we have seen in the last video, you had an original estimated liability of 14 million at the end of the 10th year. Now, if that liability goes up or goes down, now the question is, which accounting literature you have to look at if there is a change to an existing decommissioning liability, which standard to apply and when to apply. Let us see this first, and then I will give you two case studies, one dealing with increase in the liability, other one decrease in the liability. So which standard to look for? There are specific guidance given under IFRS. You have a literature called IFRIC 1, and a corresponding literature under Ind AS is Appendix A to Ind AS 16. Right? So you have to look at these two literature depending upon which framework you are reporting. If you are reporting under IFRS, then you will look at IFRIC 1. And if you are reporting under Ind AS, then you will look at Appendix A to Ind AS 16. These standards give you a guidance in terms of how to deal with circumstances when there is a change in the decommissioning liability. So what does these standards talk about? These literature provide guidance on how to account for the effect of changes in the measurement of existing decommissioning liabilities which an entity has. Then, when would you apply these two standards? When would you apply? You will apply the guidance given in these two standards when these two conditions are cumulatively satisfied. It is AND condition. So when would you apply? You will apply the guidance in these two standards when there are changes in the measurement of any of your existing decommissioning liability, which is already recognized as part of your property, plant and equipment, or under ROU asset under leases, IFRS 16 or Ind AS 116, as I also mentioned in the last video. And not only you have recognized and your present value of the liability as part of the PP&E, correspondingly you have also recognized decommissioning liability in accordance with the requirements of IAS 37 or Ind AS 37. Paragraph 45 is something which we talked about in the previous video. Right. So this is the context. Now let us see the accounting treatment of the change by by way of case studies how accounting treatment is to be done. Now, I'll just give you a theoretical framework and then we will look at the case study. So accounting for change in the estimates of decommissioning obligation is, if you look at these two literature, it depends upon the model under which the underlying asset, the underlying PP&E or the ROU asset is recorded by the entity. Now, you would be aware that under the Ind AS 16 or IAS 16, PP&E can be measured either at cost model or revaluation model. So what these two, IFRIC 1 or the Appendix to Ind AS 16, it tells you that the changes in accounting, changes in the estimate of the decommissioning liability need to be accounted for on the basis of which model the entity is applying, whether it is applying cost model or revaluation model. So assume for this video that the entity applies cost model. Then paragraph 6 of IFRIC 1 and paragraph 6 of that appendix to Ind AS 16 tells you that if you are applying cost model and if there is a change in the estimate of decommissioning liability, either increase or decrease, changes in the decommissioning liability, whether increase or decrease, paragraph 16 says, is added to, if there is an increase, add to the cost of the related asset. Or if there's a decrease, then reduce it from the carrying amount of the asset, because you are following the cost model. So if you are applying cost model, simple, increase in the decommissioning liability, add to the cost of the asset. Decrease in the liability, deduct it from the cost of the related asset. This is what the guidance is. Then there are additional consideration. So for example, if let us say the carrying amount of the PP&E was 10 and the liability is increased from 10 to say 15. So there is an increase of 5. So revised carrying amount of 15, if you are applying cost model, is depreciated over the remaining useful life. What does it mean? Let us say you had a 10-year of the life of the PP&E. At the end of the third year, your estimate changed and the liability increases from 10 to 15. So now the carrying amount of the liability at the end of the third year is 15 million. Now this 15 million, you have 7 more years to go, and therefore this 15 million will be depreciated over the balance 7 years of the remaining useful life. That is point number 1. Revised carrying amount of the asset post increase in the carrying amount of the liability, that is depreciated over the remaining useful life, in my example, for 7 years. Second, if the change in the decommissioning liability increases the carrying amount from 10 to 15 in my example, the entity should assess if there are impairment indicators, because if you are increasing the carrying amount, the generic requirement of Ind AS 36 or IAS 36 dealing with impairment will also kick in, whether this amount will be recoverable or not. If not, you have to do and test the asset for impairment. There is a second requirement in the guidance which you have got under the IFRIC 1 and the Appendix to Ind AS 16. Any decrease, so first these 2 points relates to increase, 10 becomes 50. Now what happens if there is a decrease? Let's say 10 million of the liability gets reduced to 7 million. So there is a decrease of 3 million. Any decrease in the decommissioning liability that would give rise to a negative asset. Let's change the example. Let us say the carrying amount of the asset is 10. And let us say the reduction in the liability is 12. For simplicity, let's assume that. Therefore, if you reduce 10 from 10, if you reduce 12, which is the decrease in the liability from 10, the asset will become negative 2. That you can't do. A decrease in the decommissioning liability that would give rise to negative asset of 2 you can't do that. That 2 gets recognized immediately in P&L. I'll explain this further by way of illustrative case study in the next 2 case studies. When it comes to the how do we deal with revaluation model, this we will discuss in subsequent video in the series. Okay. So in this video, we will only deal with cost model and 2 scenarios when there is an increase in the liability or there's a decrease in the liability. First case study will deal with increase in liability. Second case study will deal with decrease in the decommissioning liability when the entity is applying cost model. Let's see this. The first case study where there's an increase in the decommissioning liability and the entity is using cost model. Similar example as we saw in the earlier video also, you have a nuclear power plant, life is 10 years, SLM basis of depreciation is being followed. Entity has a decommissioning liability of 5 million at the end of 10 year. At the end of 10 year, you have a decommissioning liability of 5 million. Now, if the discount rate happens to be 8%, then how do you compute the present value? 5 million at 8% discount rate at the end of 10 year. So what would be your present value of your liability? As we have discussed in the previous video also. If you calculate this number, this will be 2.32. And therefore, at initial recognition, the entity will be required to add this 2.32 million to the carrying amount of the asset. So therefore, what it says, 2.32 million it was recognized and the corresponding amount was added to the cost of the nuclear plant. Now what happens? At the end of the 4th year, the change in the estimate of the liability gets changed from 5 million, which you had expected initially, that here you will pay 5 million, not the present value, the gross amount, 5 million. This now changes to 8 million. So the gross liability at the end of the 10th year increases from 5 million to 8 million. The entity is following cost model. How this adjustment need to be incorporated in the books of the accounts. You will apply guidance in IFRIC 1 and Appendix 2 Ind AS 16. How you will do that computation? Let's see in the next couple of slides. So you would have seen, in this I have not mentioned, but continue this, the cost of the nuclear plant was 100 million. So 100 million plus 2.32 million, 102.32 is something which you will record as the cost of the PP&E. So initial recognition will be 102.32, 100 million of the cost of the power plant, and 2.32 is the present value of the liability, which we have computed in the previous slide. And therefore, your depreciation schedule, as we have seen in the first video also, you will have PP&E recorded at 102.32. You will depreciate on an SLM basis over the 10-year period equally 10.23. Therefore, at the end of year number 10, the asset becomes 0. This we have seen similar to what we have seen in the previous video. What about liability? Same way as we discussed in the previous video. You have a liability of 2.32 opening balance. You will unwind this liability at the discount rate of 8%. And during this 10-year period, as I explained in the previous video, you will record interest expense. And therefore, your closing balance of the liability will keep increasing for every year from 2.32 to 2.5, which is 8% of this 2.32 is your unwinding of interest for year number 1. So 2.32 plus 0.19 is your closing balance of the liability. This becomes opening. And then 8% of this 2.5 million is the unwinding of interest for year number 2, and liability goes up, sum total of these two at the end of year number 2. Same way, you keep doing the calculation, and therefore 2.32 plus the total interest unwinding during this period of 2.68, the sum total of these two will give you the liability balance of 5 million as per the original schedule. Now, problem is, at the end of the 4th year, I have given this line as a separator. At the end of the 4th year, based on the original calculation, your liability, the present value or the carrying amount of the liability is 3.15. And you have the calculations which will give you 5 million of the liability at the end of the 10th year. But now your estimate has changed. So At the end of the fourth year, carrying up the amount of the liability is 3.515 million. But now you need not 5 million, now you need 8 million at the end of 10th year. How many years are yet to go? Now you have only 6 more years to go. So updated estimate of the liability which is required at the end of the 10th year is 8 million and you have 6 more years to go. So therefore, now you have to compute that what is the present value of this 8 million for 6 years at 8%. Let's see how it is. So the present value of the updated estimate of the liability will be 5.04. How? 8 million is what you need at 8% and you have 6 more years to go. And therefore, if you solve this, you need this number, not 3.15, but 5.04. So 5.04 should be the balance at the end of fourth year, which will give you 8% unwinding. And at the end of the 10th year, you will have the required 8 million of the liability balance. And therefore, now you have to increase. What is the increase in liability? This is what you need. And what you have is only 3.15. So therefore, you will have to have an increase of 5.04, this number, minus 3.15, which is your carrying amount of the liability. So therefore, because of the change in the estimate of the liability, at the end of the fourth year, 1.89 million should be recorded as the additional liability. What will you do? Because you are adding the cost, using the cost model, what the cost model says in the guidance which we have seen in the previous slide, it says the increase or decrease will be added to the amount of the carrying amount of the asset. So this 61.39 will be increased by 1.89 and this liability will be increased by 1.89. So for the recording this change of 1.89, this is the entry you will record. You will increase the PP&E carrying amount of 61.39 by an amount of 1.89 and likewise this liability will also go up from 3.115 by an amount of 1.89 to 5.04. Let's continue this in the next slide. So this is what you will do. And then go forward. After 5th year onwards, how the situation will look like. Now, your opening balance of the PP&E will be this amount, 61.39, which was plus the adjustment of 1.89. So your adjusted, after you recorded the journal entry in the previous slide, your new PP&E is 63.28, sum total of these two numbers. And therefore now you will have to depreciate this 63.28 over the balance 6 years. And therefore your annual depreciation will also go up because now 63.28 divided by 6 would be your annual depreciation charge. So you will have an increased depreciation charge of 10.55 versus 10.23 in the original schedule in the previous slides. And therefore, if you record depreciation of 10.55 every year for the next 6 years, the asset balance will become 0. How about the liability? Okay, we will come to the liability. Let us see. This was okay. Let's first complete on the PP&E. Okay, so now this 63.28, whether the new carrying amount is recoverable, I've told you that the additional consideration is that you have to see whether this amount is recoverable or not, as contemplated under impairment standard Ind AS 36 or IAS 36. If this is no longer recoverable, then impairment considerations will also get triggered. Now, on the contrary, this example case study was for increase. But what about if there is a decrease? On the contrary, if the liability is reduced rather than increased, we will see the case study next one also. But on the contrary, if the liability is reduced rather than increasing, then in that case, that amount would be deducted from the carrying amount of the asset. However, that cannot make the asset value to be negative. The example which I gave, carrying amount of asset 10 and decrease in the liability of 12, then you can't make the negative value of the asset minus 2. No, only this 2 will go to the P&L. So this was said, if the decrease in liability is more than the carrying amount of the asset, then such excess of 2 million in my example will immediately be credited to P&L. This is on the PP&E side. What about the liability? So the liability now will be at the beginning of the 5th year. What would be? It will be 3.15, which was the original liability. See here, 3.15. This was your liability, and you increased by this incremental amount of 1.89, and therefore your liability becomes 5.04. This is exactly what is there. Now your opening liability will be 5.04. And now you will use this 8% discount, your unwinding on this 5.04 and continue the same process. That will give you 5.04 plus interest unwinding at 8% on this 5.04, aggregating to 2.96 million. So 5.04 plus 2.96 will give you 8 million. This is what you needed at the end of the 10th year as per the revised estimate. And you will use this 8 million to discharge your obligation. That's how the accounting has to be done under IFRIC 1 and Appendix 2, in AS 16. Now this is the case of increase. Now let us say what happens. There is a decrease. Similar principle we will apply. Answer in this case, the similar case study, same way, nuclear power plant with 100 million as the cost, life 10 years, SLM basis of depreciation, 5 million was your original estimate. At the end of the 10th year, same 2.32, what we saw in the previous case study, we are continuing this. What is changing is this. So the point number 5 says, all other things remaining same. Point number 5 says, at the end of the 9th year, not the 4th year in the previous case study, assume that at the end of the 9th year, before you recorded the unwinding of the interest entry for the 9th year, it becomes clear to the entity that the decommissioning liability will only be 3.5 million at the end of the 10th year. Now, entity is still following the cost model. How would you do the accounting? Now, in this case, as I summarized, for the first 9 years, at the end of the 9th year, 3.5 million is the estimated liability at the end of the 10th year. Right? So how do you deal with it? Let us see this on the next slide. Now, of course, initial decommission continue to be at 102.32. Same if you the same schedule on PP&E, same schedule on unwinding, which we saw on the previous slide as well. Okay, or previous case study as well. It is the same. What is changing is in the year number 10, after year number 9. So if you see here, at the end of the 9th year, because the case study says before recording this unwinding, now you are clear that you do not need 5 million at the end of the 10th year. So you need a lower amount than 4.29. And therefore, what the entity will do, carrying amount of the liability at the beginning, or rather even if at the end of the 9th year, but before recording this entry is 4.29. Now, what you need, amount payable at the end of this 10th year is only 3.5 million. Now, this 3.5 million is lower than this 4.29, and therefore it is not actually required to record this unwinding. And therefore, since the reduction in the liability is already known, you know that you will actually be paying only 3.5 here, and therefore you will not record this 0.34 unwinding, and therefore this balance also will not be the same number. So basically this number will, if you do the same calculation, will 4.29. But let us see what we do. All I am saying is in this, that there is an excess amount. You already have a liability balance of 4.29, but you actually need only 3.5. So this liability itself you have to reduce. There's a decrease in liability to the extent of 0.79 million. What is 0.79 million? Is 4.29 carrying amount of the liability minus what you are supposed to pay, 3.5, not 5. So 4.29 minus 3.5, 0.79 million is your reduction in the liability. Now you have to record it. Why? It's a cost model. Same entry you will record. Same effect you will give. Here, you will reduce the PP&E and decrease the decommissioning liability. So therefore, you are debiting the decommissioning liability to reduce it from 4.29 to 3.5 because you are recording debit to the liability of 0.79 million. So 4.29 of the liability will come down after you record this entry to 3.5, and that's exactly what you need at the end of the 10th year. That's how you will do the accounting for decrease in your decommissioning liability. Now, what will happen? After you record this entry, your PP&E balance will come down from 10.23 minus 0.79. Sorry, minus 0.79 because you have credited the PP&E here, right? So therefore, your PP&E balance will come down from 10.23 to 9.44. 10.23 minus 0.79. And likewise, now, therefore, your depreciation for the 10th year will come down from 10.23 to only 9. From 10.23, it will become 9.44. Why? Because the opening balance itself has been reduced to 9.44. The entire amount you will depreciate in the 10th year and the asset balance will become 0. And of course, because of this reduction in the liability, this will also change. 4.63 also will get changed to 3.5 and you will use that 3.5 to discharge your obligation at the end of 10th year. This is exactly what I wanted to cover for this particular video. Again, my social media contacts are here. Please feel free to connect with me, subscribe to the YouTube channel, and give in the comments, if any specific topic which you like to be covered and whether you are liking these type of topics or not, so that I get a proper feedback in terms of what's your take is in terms of the quality of the video, anything else which you need me to cover, and I will try covering it. That's it for this video, and I will continue to cover more deeper insights, specifically on the revaluation model. If there's a change in the decommissioning liability and if the entity follows revaluation model, then what need to be done? That is something which we will continue in our deliberation in subsequent periods. This is what I wanted to cover for this video. Thank you. Take care. Bye for now.